Now we're looking at part B of the question, which says calculate the cost of capital of X company. Now, X company, remember it's an get company, which means it's all equity finance. Calculating our cost of equity from our previous syllabus, we know that according to the dividend valuation model, the cost of equity is D0, which is dividend today. Then we factor in the growth rate, 1 plus G, divided by the market value plus G. This gives us the cost of equity. This formula is based on the perpetuity formula, where if we're trying to determine the value of a company, PE, assuming the dividends are going to be paid in perpetuity, is the dividends, we discount them at the cost of equity. If we rearrange this formula and we include growth, that's how we get to this formula. And here another thing to remember is, since this company is all equity finance, its cost of equity is equal to its weighted average cost of capital. We're told here that X company pays an annual dividend of 450,000. In this question, there is no growth, so G is equal to 0. Then the market value, it's 3 million. Say 450,000 divided by 3 million. We get 15%. That will be the cost of equity in the get company, which is also going to be the weighted average cost of capital, since this company is all equity finance. So that's it on the part B. So part B is fairly simple. We just have to know how to calculate the cost of equity in a get company. Based on our dividend valuation model, this is the formula. We apply the formula, we get our cost of equity. Now we're going to look at part C of the question. It says calculate the cost of equity of Y company and the cost of debt of Y company. Just to recap the question, Y company has debt and has equity. We did the first part where we calculated the value of the equity. We got 2 point something, then the value of our debt was 900,000. Now we want to know what is the cost of the debt, what is the cost of equity. We start with the cost of debt. Now, cost of debt, first we have to know, is our debt irredeemable or is our debt redeemable? Now, this we did in the F2 syllabus, but just to recap, if debt is redeemable, then the cost we find it by applying the internal rate of return formula, which in this case, obviously, we're not going to do this. So to calculate the internal rate of return, we need to have two cost of capitals. We need to have the net present value. Then we can get the cost of the debt. And our debt can either also be irredeemable. With irredeemable debt, we assume that we're going to pay interest in perpetuity. In this question, we're going to assume that our debt is irredeemable. If our debt is irredeemable and we're going to pay interest in perpetuity, then our formula is interest over the market value. This is the same formula as what we use when we calculate cost of equity. They're all based on the perpetuity formula. The concept on the cost of equity is saying we're assuming that dividends are going to be paid in perpetuity. So we took the dividends divided by market value. Here the cost of debt, assuming it's irredeemable debt, we also assuming that interest is going to be paid in perpetuity. We take the interest divided by market value. And depend, do you want it post-tax or do you want it pre-tax? If you want it post-tax, then we have to add the 1 minus the tax. But here, let's first calculate it pre-tax. Our interest is 72,000. The market value of debt is 900,000. Divided by 900,000. What we get is 8%. 8% is pre-tax. If we want it post-tax, we take 8%, 1 minus 0.33. So it is as a decimal. Here I'm going to keep it as pre-tax because the next question requires us to calculate the cost of the equity. Calculate our cost of equity. This is for a get company. We're going to use the formula for calculating cost of equity in a get company. Remember we had slide number 49 when we looked at the three formulas. The first one was to calculate the value of a company. And I say that formula we use it when we either want to calculate the value of the company as a whole or the value of the equity. So you have the cost of equity in a geared company, which is the second formula that we need to use, is cost of equity in a geared company plus cost of equity in a geared company minus cost of debt, value of debt over value of equity, 1 minus the tax. The cost of equity in a geared company already we have calculated, which was part B of our question, the X company. That it was 15%, 0.15. So plus, take 0.15 minus cost of debt here. We needed pre-tax. This formula when I was explaining the slide, so we need this pre-tax, 0.08. Get our value of debt, which is 0.9. The value of equity. This company, we calculated the value of equity, which was our first part. So already I've wrapped this off. I just need to check with the answer how much we got. It was 2397. 2.397. 1 minus 0.33. This is our second formula. Now we just have to use our calculator to get the answer. Now we're just going to use our calculator to get the answer. We start with this first part here. We'll take 0.15 minus 0.08, that's 0.07, times 0.9 over 2.397, close bracket, times 0.67 plus 0.15. Yes, 16.76%. So this is the cost of equity in the geared company. According to Modigliani and Miller, we take this as true because we say the moment we introduce debt capital into our capital structure, the cost of equity is going to increase because now there's more financial risk. We have to pay interest payments, we have to pay the principal amounts. Therefore, our cost of equity is going to increase. Remember here, the cost of equity in an ungeared company is only 15%. Because in this company, there are no debt obligation. Then the moment we introduce debt, in this company, they have 900,000 worth of debt. Therefore, there's more financial risk. Therefore, our shareholders now require a higher return. For our cost of equity goes up to 16.76. Now in this question, first we had to determine the value of the equity. And we saw how we determined this. We got the value of the whole company first. Then we went on to get the value of the equity. We used our first formula, which was VG is equals to VU plus the tax shield. So that's it on our question, part C, the cost of equity and the cost of debt. Now we're looking at the last part of the question, part D. Part D requires us to calculate the weighted average cost of capital. Now we're going to use the third formula. For our part A, we use the first formula, which is VG is equals to VU plus TB. Went into the second part, the cost of capital for X company, which was the cost of equity because it was an all equity finance company. We use a dividend valuation model formula. Then the part C, calculating the cost of equity, we use the second formula, which is a KEG is equal to KEU, on and on. Then the cost of debt, we use the perpetuity formula to calculate the cost of debt. Now I want to look at the weighted average cost of capital. We use the last formula. Now the last formula is calculating the weighted average cost of capital in a geared company. How you calculate it is, take the cost of equity in an ungeared company. This is equal to the weighted average cost of capital in an ungeared company. 1 minus VDT, VD plus VE. Our cost of equity in an ungeared company is exactly the same as the weighted average cost of capital. Because if a company is not geared, it doesn't have any debt component. Therefore, its cost of equity is equal to the weighted average cost of capital, which is 0.15. 1 minus, our value of debt was 0.9. Take 0.33. So 0.9 plus 2.397. Which is our total value of the company. So we start off with our brackets. So 0.9 and 0.33 divided by 0.9 plus 2.397 minus 1 times 0.15. Our weighted average cost of capital is 13.65%. The weighted average cost of capital in a GET company is lower than the weighted average cost of capital in a GET company. And this follows Modigliani and Miller with tax principles. If we introduce debt, debt has a higher impact, a higher downward impact than the upward impact from the cost of equity. From the previous question that we did, we noticed the cost of equity in a GET company was 16 point something. Then the cost of equity in a GET company was only 15. But because we've introduced debt, the downward effect from debt outweighs the upward impact from the cost of equity. Therefore, our weighted average cost of capital falls to 13.65. The more we introduce debt, this will continue to decrease. And we say the optimal capital structure according to Modigliani and Miller with tax is 99.9%. That's before we consider the practical consideration or a real world scenario. So that's it on this question. Let's test your understanding. 2. We're now looking at capital structure in the real world. Some of the practical consideration that we need to look at is 1, the company's ability to borrow. Not all companies are able to incorporate debt in their capital structure for various reasons. One of the reasons is if a company has variable cash flows, then it's not a candidate for loans, especially if we're looking at a bank. When a bank wants to loan you money, one of the key considerations or one of the things that they require, primary requirement is, in the future you should have sufficient cash flows to meet the interest obligations. For startups, because of the variability of their cash flows, they might not be in a position to get debt from the bank. With the Modigliani and Miller with tax, as much as a company would want to incorporate debt in their capital structure to reduce the weighted average cost of capital, it's not always the case because it might not be able to borrow because maybe they don't have collateral to offer when they're borrowing. And number 2, it's existing debt covenants. When you borrow money, we looked at this in chapter number 6, there are debt covenants, some of restrictions that you might get from whoever is giving you the money. They might restrict you from issuing further debt, or they might allow you to issue further debt, but it has to be subordinated. It has to be a lower ranking than their debt. It might restrict you in terms of your dividend, the flexibility of the company is reduced. So here the key thing is with existing debt covenants, if you're not allowed to issue further debt, then that restricts the company from having more debt, which is going to reduce the weighted average cost of capital. Number 3 is increased cost of debt finance. Debt finance, 1, is not going to be risk-free, and the more you have debt, or the more you introduce debt into your capital structure, the cost of debt finance might increase. The debt holders will also feel like there is more risk in this company because they have too much debt. And you need to consider the views of other stakeholders as well as rating agencies. And we have what we call tax exhaustion. Although interest is tax deductible, you might get a situation where you have exhausted all the tax benefit that you can get. Means the profit that you have generated are less than the tax benefit that you could likely get in that particular period. These are some of the practical considerations when you look at the real world scenarios. Although in Modigliani and Miller with tax and without tax, as well as the traditional view, most of the things that we're talking about were theoretical. We also need to consider this practical consideration when we look at real world scenarios. Moving on, we're looking at slide number 51, consideration for a group of companies. The first consideration is tax issues. On tax issues, we have local tax issues. We also have international tax issues. Our international tax issues are governed by the OECD. One of the primary aims of the OECD is to promote globalization. They have ways of trying to reduce double taxation or the impact of double tax. With our tax issues within a group of companies, it makes sense to maximize borrowing in regimes where there is the highest tax rate, meaning that you're going to benefit more from the tax shield. If you have country A and country B, country A is a tax percentage of 30%, country B has 50%. It makes sense to borrow in a country like country B, where you're going to get a higher tax shield because of the higher tax rate. And tax relief can be limited in some instances by transfer pricing issues and also by thin capitalization rules. Because governments have noticed that companies are trying to reduce their tax impact by using transfer pricing, then government has come up with ways of trying to eliminate this by what we call thin capitalization. We're going to look at it as a point. It's our fourth point. But on tax issues, we have to know that We have to consider local tax issues as well as international tax issues. And number 2, there's country risk. If you're going to raise finance, say from issuing of debt, it makes sense to raise the finance using your local currency. It reduces the risk in that case. So we call that country risk because there will be less exposure to risk if an entity borrows funds in a country where it generates its income. It's a matching concept. They're matching their revenues to the expenses. If you generate your revenue in dollars, then you'll also want to borrow your money in dollars. So when you get your income, you use that income to pay off your interest obligation. Then any servicing costs for finance are paid from the income that is generated. This eliminates the exchange rate movement risk. Number 3 is the type of finance provided by the parent. The parent can provide finance to a subsidiary in the form of share equity finance or debt finance. It doesn't have any difference on the cash consideration of the subsidiary. Then we have transfer pricing. Now, transfer pricing adjustment may be necessary for transaction between connected parties. We have in our accounting IS 24, which is a standard that governs related parties. Some of the related party transactions are not at an arm's length transaction. Or therefore, we need to look or consider this transfer pricing issue, where the government comes up with minimum or maximum transfer prices. In the context of capital structure, this means that if one company in a group has borrowed money from another in a group, an adjustment will be necessary if it is deemed that the interest charge is not at the market rate. If subsidiary borrows money from the parent, they borrowed 10 million from the parent. If the subsidiary had gone to the bank, they only had a capacity to borrow 5 million. Then what the government does is, when they're looking at the interest that the subsidiary has paid, they only have to consider the market rate of interest that they would have paid if they'd got this loan from the bank. So those are some of the transfer pricing issues. That's it on our slide number 51. Moving forward, we're now looking at slide number 52, thin capitalization rules. The aim of thin capitalization rules is to ensure that companies do not get excessive tax reliefs. So it aims at stopping the companies from getting excessive tax relief on interest. If the parent invests in a subsidiary in the form of equity, the parent will receive dividends. Dividends are post-tax, so you won't have this issue. But if a company parent loans out money, so he gives finance in the form of debt, the subsidiary will need to pay interest and they get tax relief on the interest. Or you might have a situation where now the subsidiary could have got a loan of 100 million from the parent, but ordinarily if they'd gone to the bank, they could have maybe only got 50 million. So the thin capitalization rule now tried to reduce or tried to stop companies from getting excessive tax relief. They only get tax relief that is equivalent to what the loan interest amount that they would have paid if this transaction was an arm's length transaction. There is to ensure that interest on the part of the borrowing that an independent third party would be prepared to lend the company is allowed. Just like the situation that I gave you. If the subsidiary could only borrow 50 million from the bank, but they got 100 million from the parent, the interest is only going to be calculated on the 50 million. The excess is going to be disallowed. And the borrowing capacity of individual companies and this subsidiary also has to be considered. Those are some of the things that we need to consider. And factors determining the thin capitalization is the gearing of a company. So the gearing is a measure of our debt to equity. We talked about this. And this can be incorporated in the legislation of that particular country. Example, in the UK, there's a limit of 50 to 50 by the tax authorities. They consider that to be reasonable. Debt should only be 50% off. 50 to 50 means a 1:1 proportion compared to equity. Then we also need to look at interest cover. This interest cover is the ratio that measures how many times is the company able to meet its interest obligation. And many commercial lenders will look for a ratio around 3. So this figure is considered also by tax authorities. So although in our textbook, sometimes we consider interest cover ratio of 2 to be okay. But when you look at commercial lenders, they might take it as far as to 3. If the interest cover ratio is 3, it means that a company is able to pay 3 times its interest from its operating cash flow, which is quite a healthy ratio. Therefore, the tax authorities also want to consider that as a reasonable amount, as a reasonable ratio, 3:1. So those are some of the factors that determine this whole thin capitalization. So that's it on our slide number 52. And before we wrap up this chapter, we're going to look at some extra questions. I'm looking at test your understanding 7 in my book. The question will come up on your screen. It says, according to Modigliani and Miller theory with text, calculate the work, or work could move to what? And when we calculate in work, we're using formula number 3. The cost of, which is the weighted average cost of capital in a get company is equal to the weighted average cost of capital in a get company, 1 minus VDT, VD plus VE. Always when we want to calculate the weighted average cost of capital, we use the third formula. We taught the current cost of equity, the ungeared cost of equity, the current work, the market value of equity, the market value of debt, the tax rate. And we're told that the company plans to raise 20 million debt and use this funds to repurchase their shares. We need to determine the value of equity in this new company, because we thought equity was 210, the debt was 70, means the value of this ungeared company was 280. First, we just need to determine the value of ungeared company. So value of the get company was 280, 210 here was equity, 70 was debt. The value of an unget company is X. The tax shield here was from the debt. The debt was 70 million. So 70 times 0.3. Well, therefore, we need to determine the X here. So 280. Well, the value of an unget company will be 259 million. The reason why we want to first determine the value of an unget company is this company wants to borrow 20 million and use it to repurchase some of its shares. Means this debt is going to move to 90. Therefore, to get the value of the get company, we need to first know what is the value of an get company where the tax shield. Now that we know how much the value of an unget company is, then we can look at the new value of this company. The value of the unget company is going to equal to the value of an unget company, 259. This company is going to have 90 million in debt. 90 times 0.3. The value of the get company will be 286. The value of the get company. This value of the get company, part of it is debt, part of it is equity. Our debt is 90. Therefore, equity is 190. Equity is going to be equal to 196. So the previous value of our equity was 210. Now in this case, it's going to be 196. So that's the first part of the question. Determine the value of equity, determine the value of debt, because we need it in our formula of calculating the weighted average cost of capital. Continuing with the question now. To answer the question, we want the weighted average cost of capital in a get company. So first we need to know what is the cost of equity in an unget company. Remember, the cost of equity in an unget company is exactly equal to the weighted average cost of capital. And 1 minus the value of debt. We know the value of debt. And we've calculated the value of debt and the value of the new equity. So cost of equity in an unget company is 10%. So 0.1. And 1 minus the value of debt now is going to be 90. Our text in this question is 0.3. And the value of the debt and the equity, we got it as 286. So 90 was the debt, then the difference, which was 196 was the equity. But here we want the value of debt and the value of equity. Therefore, we can just keep it like this. We say 90 times 0.3 divided by 286. 1 times 0.1. The weighted average cost of capital will be 9.05%. 9.055. Means if you round this off, it's going to be equal to 9.06%. So that's it on this question. You can just recap this question. Reason why we had to first determine the total value of the company is company had a value of 210 plus 70, but then it introduced more debt into its capital structure. So there was an extra 20 million, and this 20 million was used to repurchase the shares. We got the new value of the company is 286, and its weighted average cost of capital goes to 9.06. Before it was 9.25. This is in alignment with Modigliani and Miller with text. The more debt capital that you introduce into your capital structure, the lower you have your weighted average cost of capital. Remember from our graph, according to Modigliani and Miller with text, our weighted average cost of capital will fall all the way into 99.9%, which is ideal capital structure. So that's it on this question. We're going to look at more questions. Now looking at another question, test your understanding 10. It says, until recently, VV was an Unget company with a cost of equity of 13%. Its cost of equity in Unget companies, 13%. And it recently issued some debt finance, and its cost of equity increased to 14. I mean, the cost of equity in a Get company now, it's 14%. This company now has debt. Then VE pays a tax of 20%. Its yield required by lenders is 8%. What is the gearing level? We're going to use our formula number 2, which is cost of equity in a Get company is equal to cost of equity in a Get company is equal to cost of equity in an Get company plus cost of equity in a Get company minus cost of equity in a Get company, VD over VE, 1 minus the tax. What this question wants us to calculate is, says, what is the gearing level measured by debt to equity? It wants us to figure out this ratio. We know that the cost of equity in the Get company is now 14%. Cost of equity in a Get company is 0.13. And here we take 0.13. Sorry, this is supposed to be cost of debt. Sorry about that. The cost of debt here, we say it has to be pre-tax. The pre-tax cost of debt is exactly the same as the yield required by the lenders. The yield is from the lender's perspective. Then the cost is from the borrower's perspective or the issuer. So normally the cost of debt is post-tax and the yield is pre-tax. Reason is when you borrow, you're going to pay interest and it's going to be tax allowable, so your cost debt is post-tax. But the lender, when they receive the interest, it's pre-tax. That's their yield. They're going to be taxed in full. And in our formula, year one, the pre-tax, so which is the same as the yield on the debt. So on the yield on the debt, we told it's 0.08. 0.08. This ratio, we just call it X. The tax, 1 minus the tax. Tax is 20%, so this becomes 0.8. Now we just have to solve, take the 0.13 to this side, 0.01 is equal to 0.13 minus 0.08 times 0.8, 0.04, 0.04 x. Therefore, x is equal to 0.01 divided by 0.04. The ratio is 0.25. The answer is A there. Now here we just rearrange in the formula. What we wanted is the value of debt or value of equity. In the exam, the examiner might want the cost of equity in a Get company. They might want the cost of debt. They might want the tax. We just have to make the variable that we're looking for the subject of the formula.